In today's video, we're going to look at buy side and sell side liquidity. I have a summer sale running at the moment on my trading course and community. If you want to join either of those, the link is in the description for this video. You'll be able to save 30% off using the code SS30, so make sure you apply that at the checkout. If you want to learn from me and trade with me, that's the place to be. When the sales over the Discord only option is going to be removed for some time, so if you do want to just join my trading community, make sure you do that before the end of September. Now check out the video, I hope you enjoy it. Hello everyone and welcome back to the channel, I hope you're doing well. In this video, I'm going to break down buy side liquidity and sell side liquidity, explain what the differences are, what they mean, and how we can actually use them to our advantage to get more clarity on trades in the market. So what you can see up here is a little markout that I've done for buy side and sell side liquidity. So first off, what is liquidity? Well, liquidity essentially refers to orders in the market. And what price does is often reach for these orders, which means taking out highs and lows in the market. Now, if we were to boil it down to the most basic sense, if we look at this range here, we can see that we have support and resistance. Now below support, we usually know there's going to be stop losses for buyers of support. So there may be people with orders to buy here, or maybe they're in from here, and they have stop losses just underneath. So there's orders there for that. Now there's also going to be sell stop orders. Basically what that means is if the market is to drive through this low, traders are going to be tagged in on sell trades to ride the market down. The same happens on the buy side. If we have a resistance level, we know a lot of retail traders will be selling resistance with stop losses here. And we also know there will be retail traders with buy stops there. So if the market pushes above, they are going to be tagged into buys, hoping that the market will continue up. So what we are left with are a bunch of orders either side. These orders are therefore known as liquidity. And that is what we're talking about when we use the term liquidity. With a collection of orders above and below the current market's range, that leaves us with orders to sweep. That leaves us with liquidity. Now that then brings us into the topic of today's video, buy side and sell side liquidity. This video is not designed as a tutorial to show you a trading strategy, but more so to help you understand the concept in the market so that you can start to use that to your advantage and see it more when you're trading. The two types of liquidity we have are buy side liquidity and sell side liquidity. Now they're essentially the same thing, but they point in either direction. Buy side liquidity refers to buy stop liquidity. So buy side liquidity is going to be on the buy side. This is the side of the market where the buying liquidity is, those buy stop orders. As well as the sell stops, being those orders that are going to be triggered in if the market pushes above, we also have buy side liquidity based on stop losses, right? We know that when we sell into the market, we are essentially selling contracts with the promise to buy them back later at a different price. If the price was higher, we would have to then buy it back with a loss. And that basically is where our stop losses will come in. So let's say we have people selling here, here, and here. Their stop losses are going to be here. So if they've sold with a promise to buy back, if the market was to push above here, not only would we have the buy stop orders, we would also have buying liquidity, right? So we would have the stop losses being hit, and these short positions, these sells, would be bought back into the market. If we think about how the market works, every time there is a buy, there needs to be someone on the other side to sell. And if we think about institutional market participants with very large orders, they need to open up buy orders in order to then sell to these guys. So if a institutional participant wanted to sell loads of quantities of, an asset, for example, if we were looking at GBP USD, if the smart money wanted to get a big sell on GBP USD, they would need to open up liquidity because there's not enough money in the market ready for them to just take the position. There's not enough people for them to sell to right now without actually opening up liquidity and opening up the willing buyers here who are going to be buying back on losses and also opening buy stop positions hoping to profit. So the buy side liquidity will actually come in when the market pushes above. We may get a push upwards to take out the buy side liquidity. That's going to hit the stop losses of all of these sellers and also actually trigger in buy stops to the people buying. So all of these buys will come in here, providing massive selling orders into the market for the people on the other side. So this is an area where institutional participants could actually get their major orders on. They could get huge sales on here, and then that may sell the market down. So that is buy side liquidity. That's why it's called buy side liquidity, and that's kind of a brief introduction to how it works in the market. Now, you guessed it, sell side liquidity is very similar. If we have a bunch of lows in a range that look like a support floor, we know that there are going to be buyers here, 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 and here. They're going to have stop losses below. There's also going to be sell stop orders below, meaning if the market is to push down, more sellers will be brought into the market here. As we know, the contracts have been bought in here, the stop loss is here, and obviously if the stop loss is to be hit, these buys will be resold back into the market. As well as that, these sell stops are going to provide more selling liquidity, meaning if someone wants to buy contracts, they will catch the other side of all of these retail liquidity orders here to actually then accumulate large buy positions. So what we will see in an instance of sell side liquidity quite often is a push below, followed then by a push back up and potentially even a large rally in the other direction. Because a lot of selling has came in here in terms of stop losses and stop orders. There needs to be a buyer on the other side of all these sells. And if one participant is to add massive orders to the market, that can actually then flip the direction of the market and move it upwards. Now, I don't claim to know how banks trade and how institutions trade, but this is the best general idea we can get. It is theory based, but basically we know that to open the large orders, and you can see this by looking at footprints, etc. as well, the market does need to reach for these liquidity points. And then often large orders in the other direction will be opened, and they are what's going to form those large drives in the market. So if you're a support and resistance trader and you've been stopped out a lot of times and you're constantly getting wicked out by small movements like this, that's why. Because of the liquidity, you are essentially providing the liquidity to the bigger players in the market who are looking to accumulate those large buy or sell orders. So what I'm going to do now is go over to the markets and show you an example of buy and sell side liquidity so you can see it in action and understand how much of a part liquidity actually has to play. So what you can see on the chart now is the Asia session. So this is the Asia Pacific session, which trades between this low and this high. And as you can see, it's kind of formed a range of sideways price action. We had a high, we came down, we formed these equal lows, and we haven't yet broken over this high. Now, the reason that I'm using the Asia session for this example is because the Asia session usually trades sideways for Europe and US based currencies. So for the Asia Pacific session, if you're looking at NZD USD, NZD JPY, USD JPY, they will have some reasonable movement because they are Asia Pacific focused currencies, the yen, the New Zealand dollar, the Australian dollar. But if you are looking at GBP USD, Euro USD, Euro focused stuff, pound focused stuff, Swiss franc focused stuff, without Japanese yen, New Zealand dollar, or Australian dollar crossovers, they are generally going to be flat. So you're going to get volume through London and New York. You get, these big pushes. But then when the Asia session opens up, we actually trade sideways. So this is a prime area for the buy and sell side liquidity to formulate. So into the day, let's say we have buyers in here, we have sellers in around this level. The market is usually then going to reach either side of the range and actually take out the liquidity both sides. So up here we have buy side liquidity. Why is it buy side? Because this is where the buyers are going to be looking to come in. We have the buys coming in from stop losses of sellers, and we also have the buy stops coming in for breakout traders. And down here we have the sell side liquidity. This is the other way around. We have the sellers waiting this side and also the selling stop losses of buyers that are buying in at the low of the range. Now, it doesn't have to surround the Asia session. Buy side, sell side liquidity will come in many different places in the market, and you'll see it actually formulate quite a lot. But this is a very good example and definitely something that you might be able to work into your trading. I actually have a system built entirely around the Asia liquidity, the buy side and sell side liquidity for the Asia session. So maybe you could build something similar. Or obviously, if you want to use it in trading elsewhere, it's going to give you a better understanding of why the market is moving, how it's moving. So now we have our range. This is the low of the range. This is the high of the range. And what we will likely see quite a lot of the time is the price to take out both sides. So as we can see here, the market has taken out the high. That is then going to obviously trigger in buy breakout traders, take out stop losses of any sellers if there were any sellers around this level. And then at this point, the market actually uses those orders and sells back down. So remember we said at this point, there's a lot of buying coming in. That means on the other side of all that buying, a big seller can come into the market and actually sell many more contracts than these buyers are taking on. That is then going to sell the market off and run it down towards the sell side liquidity. When we hit the sell side of the market, the opposite can often happen, where we will essentially be closing out a lot of these buys as sells. So large market participants can collect the large buy side of this order and actually take the market back up through into the highs. So that is buy side and sell side liquidity used together. Now, often what we can see with buy side and sell side liquidity is that this actually could continue down into a larger down move, right? We saw a sweep here. We saw a sweep here. Now the market has pulled back up. There may actually be a point for us to sell into the market because we've already swept the liquidity this way. We've already swept the liquidity this way. So now this could follow through into a true move. Now looking at this market, you'll see it actually does then continue down. And the reason it does that is because the liquidity has been collected either side of this market. Now, it is strange that we always see the high and low swept out before moving away, or not always, but very often, of ranges in the market. But it can be used to your advantage. You could build a system around this, or you can just help to stay out of trades, not buying into these equal lows, not buying into traditional support floors, knowing that they're probably going to be taken out before the market does make its proper move. or selling into resistance, knowing that will probably be taken out before the market flips down. So there is a lot to take from the concepts of buy and sell side liquidity. And if you study it in the markets and you go and backtest, you're going to see how this can be so valuable. I hope this video has done its job of introducing you to the topics of buy side and sell side liquidity. And I hope you can take this away and go into study mode on the charts and actually see this for yourself happening in the markets. I hope I've given you a brief understanding of what it is, how it works, and why it happens. And if so, please do let me know in the comments. And feel free to drop a like. That's going to help me reach more people. If you want to learn how I use liquidity in my tradings and the system that I've built directly around buy and sell side liquidity, head over to the link in the description. There's a summer sale on now. You'll get access to my full trading course and you'll be able to trade these systems with me every day as well. So most importantly, I hope you've enjoyed this video. Thank you for watching and I'll see you in the next one.